So when you look at credit card debt that's sitting at a record high, this is showing us that the consumers are stretched. People have just assumed that we won't have any inflation problem. I'd be very careful there. I don't think that inflation is fully behind us. I do believe that the deficit is an issue. I think it's a major issue. I think the biggest risk from an investment standpoint is in the long-term part of the Treasury curve. Debt is a global problem. So Europe's got it. Everybody's got a debt problem. There's no way that these countries that are our biggest holders of our debt can dump their holdings. Cut interest rates by 24 basis, deliver it with a hawkish tone. I think most people think that passive investing is the only way to do things. And I think that, again, is a recency bias.
Megan, welcome to Excess Returns. Thank you very much for joining us.
Thank you for having me.
What we thought we would do with you today is actually take something that you wrote earlier in the year. It was your 2025 themes and outlook, the Year of Fragile Optimism, which I love that title, and sort of go through a number of themes that you and your firm were thinking about in terms of the markets and the economy. And what's interesting is, sort of forecasting pieces like this are somewhat challenging and difficult because no one really knows the future. But at least so far, I would say you guys were more on the accurate side with some of this. So I think it's cool when stuff actually comes kind of true to some extent.
Right.
And so, we'll just kind of work through these. And if you want to read the full piece, you can go over to verdence.com. It's verdence.com and look under their Insights tab, and you'll find this piece as the first one. So your first theme was around the expansion here in the U.S. and that I think, the messaging there was you thought the expansion would continue, but it would be at sort of a slower pace. Is that right?
Coming into this year, and this is if you take tariffs out of the equation, the new administration out of the equation, let's just back up into what we saw in 2024. And what we saw was that the consumer was just very stretched, continued to spend. Basically, they were funding inflation, though, on credit cards. So when you look at credit card debt that's sitting at a record high, this is showing us that the consumers are stretched. Now, we've also had a lot of questions about, well, nowadays everybody uses a credit card and no one uses cash. So how can you really look at credit card debt as a sign that the consumers may be in trouble? Well, that's where we go to a couple other indicators. One of them may be just delinquencies, how many people are missing credit card payments. And we've seen that consistently rising. The other indicator that we've looked at is those credit card consumers that are just making the bare minimum on what they're required to make. That also has been rising. So those are the things that show us that consumers are starting to really feel that pain of the past couple of years of inflation. So when you look at the consumer, which makes up 70% of GDP, if the consumer starts to slow, that's where we expected the economy to slow. Now, we've seen the consumer be resilient in the previous years for many reasons, and we can touch on that in a bit if you'd like. But all of that stimulus and all of that euphoria that came out of the pandemic is spent. The savings rate had reached some pretty below average levels. And we're looking at consumers that their confidence was starting to weak. So our biggest concern coming into this year, regardless of tariffs, regardless of the administration, was really the consumer.
Let's talk about that. So there's some cracks maybe in the surface with some of this consumer data that you're talking about. But to your point, the economy has hung in there. Consumers have hung in there. Why do you think the economy has been so resilient? What's the underpinning in your mind?
Well, I think the underpinning in the past few years has been just the enormous amount of stimulus. There was so much stimulus given out after COVID that this is what really supported consumers for many years. And then you had the Fed hiking interest rates and getting to a hawkish tone in hiking their interest rates. But then they came in last year, the second half of the year, and decided to start actually aggressively cutting interest rates. When you cut by 50 basis points, that's saying, hey, we're going to be on this consistent cutting interest rate path. But that can also create this false sense of hope and optimism that the Fed's going to come in and save the day. And unfortunately, that's what we saw with consumers. We saw that the Fed came in, was aggressive, cut interest rates, and then consumers actually had in the fourth quarter of last year a little bit of boost in spending. And I think that's because the anticipation when you came into this year was that the Fed would continue down this interest rate cutting cycle. So consumers were spending in advance of the hopes for lower interest rates.
What is your take on the tariffs? Obviously, the market has come all the way back from, I think it was April low or something like that. It's like up maybe over 20%, if I have my numbers right. And so the market and investors have sort of said, oh, the tariffs aren't going to have that much of an impact, at least according to the stock market. But what do you think of the tariffs?
So then that's a loaded question there, Jason. What do I think of the tariffs themselves, and what do I think what that means for the market? So without taking too much of a political stance, I do think that it is the time, and I think this might be the administration that will do it, that we start to reevaluate global trade. Not just, how we trade. This is globally what has just drifted to what the pure explanation of what a free trade was. Let's remember that when global trade really started to take off, it was supposed to be in some form of reciprocal tariffs when it came to that. But over the years, that has just drifted. And many administrations, it's not just Republicans, it's not just Democrats, they've let this go on and drift to where, there's certain things that were being tariffed on in a pretty substantial manner, just so these other countries can protect their own individual sectors of their economy. Agricultural is one big thing, whether you look at agricultural in Canada and some of the agricultural tariffs that Canada put on us. So I think the fair trade has really just kind of deviated from what it really should be. So in tariffs in general, if it can address fair trade, I think there can be benefit to not just the U.S., but many other economies. And I think that the way that the current administration articulated this was aggressive and a bit harsh and misleading to most Americans. And most Americans don't understand how trade works. They don't understand how tariffs work. They don't understand what some of the different tariff rates are on specific products. Look at Harley Davidson motorcycles, for example, and how their tariffs so high in other countries, or our auto countries being tariffs it's so high. I think the education part of this, really, they dropped the bomb on that one. I think it could have been articulated in a very different manner where it didn't turn into such a divisive rhetoric, and that translated into other countries getting pretty divisive on that. But I also think that there was a lack of communication on what fair trade truly is. Fair trade being the fact that whether it's China and with our intellectual property, some of these things, I don't think that the average Americans know how some of these other countries are treating us in a very unfair manner. So I think tariffs, not in all of their current form, because let's keep in mind we're kind of on this hold period, but I would rather not even use the tariff word and use more of leveling the playing field from a global trade perspective. I think that's a much better way to articulate that. What this ends up being and what part of that is a tariff, we don't know at this point, but I think it's due time to level the playing field, because to be honest, our deficit is way out of control, and there is, from a security standpoint, we saw that with COVID and us relying on other countries to, from a pharmaceutical standpoint. But there are a lot of other things underlying this entire trade disagreement. So this trade, I hate to use the word trade war too, because it's such a harsh word, but this whole trade situation, there's so many other things than just a 10% tariff or a 20% tariff. That's where I think that we can address this, and it can benefit not just the U.S., but maybe other economies too.
You mean that when Trump was on the White House lawn with his sign with all the countries, and it was like 150%, 120%. So to your point, it was like aggressive, and I think they thought they were articulating it, but it kind of missed the mark, and people were like, what is going on? So that's a very good response to my loaded question. So thank you.
Thanks.
Last question, I guess, on this theme is, what do you think investors are maybe misunderstanding or underestimating about the current macro setup?
When it comes to underestimating, I think, the one thing that I think people have kind of pushed to the side, especially with some of the data that we've gotten this week, is inflation. We have seen inflation improve substantially from, CPI being at 9.1% at one point, all the way down, getting close to the Fed's target. But some of this inflation data that we're seeing isn't fully impacting even that 10% universal tariff. We do need to keep in mind that there still is inflation risks. And I think because the administration is now having active conversations with a lot of different countries, that people have just assumed that we won't have any inflation problem. I'd be very careful there. I don't think that inflation is fully behind us. If you look at things like the ISM Services Index or the ISM Manufacturing Index, these are two different indices that measure two very different parts of our economy. They measure manufacturing and they measure services. We spend the majority of our money on the service sector. Both of these underlying components, when you look at their prices paid, are very elevated, showing that those inflation pressures are not behind us. So I think there's going to be a lot of volatility around the inflation information here in the near term, but I don't think inflation's fully behind us. My biggest fear is that the Fed gets too complacent to that as well. And we'll get some information when we have their next meeting. But I am concerned that they'll come in, I don't think in the next meeting, and I don't think in July, possibly, I think probably September they'll cut rates, but they have to walk that very fine line not to reignite inflation. They made this mistake in the second half of last year. By getting too aggressive, by cutting rates, they reignited inflation. So that's the one thing I think we as investors and as an economy cannot be complacent on.
That was a very skillful way, by the way, to negotiate it, to get into theme number 2, which is the inflation battle's not over. But before we get into that, I wanted to ask you one question about tariffs, one more that ties the two together, which is, you had the outlook for slowing growth coming into the year. You had the outlook, the inflation battle's not over. How do you think about tariffs in light of both of those? I mean, do you think more slowing growth? Do you think more inflation? How does tariffs affect those two themes?
So I think tariffs just adds to the volatility and the uncertainty, especially since we keep kicking this down the road. So we had Liberation Day. Fortunately, we had, some of the bigger, people in the administration come in and decide that, hey, let's push it down. You can't refigure trade agreements that have been in place for decades in a day. So, pushing that down, pushing that out, giving these 90-day pauses, all of this, I think, is very beneficial. But it's just being pushed down the road. So having some concrete or foundational agreements, because also keep in mind that even if we have the framework and then these countries abide by that framework, having these, things in writing and all this is may not necessarily have to happen immediately, but we do need to have a framework that's agreed upon by our biggest trading allies, and having a framework with China is also a very big plus. But I just think unless we put in, not an end, but have some more concrete foundational agreements there, that this volatility is just going to continue, and we could be right back here again coming in July when some of these roll off. So I think that it just, to my themes, as you mentioned, to the slowing growth, I think it's just another source of volatility, at least through this summer.
And to your point, this is such a tough environment because of the binary risk. Like, it's hard to analyze the impacts to growth and inflation because we don't know what the tariffs are going to be. Obviously, 40% tariffs and 10% tariffs are a very different thing from the perspective of those. So it must be a challenge, like trying to analyze it when it's a binary decision we don't know what it's going to be.
Exactly. And it's very difficult, not only, from a macro standpoint, but it's also very difficult from the corporate standpoint. What are they going to do? And I think that's been echoed through the earnings season reports that we got for the first quarter. And we'll get more information when we come into July with the second quarter earnings. But When you have consumers that are concerned and their confidence is weak, and you have businesses that just don't know, this creates kind of like a stall in economic growth. And I think that's what we're seeing. It's not collapsing, but we're just kind of stalling out where we are. We're not getting this big, accelerations we've seen in the past couple of years. We're just kind of stalled here. We're in a waiting mode.
How do you think about that as in terms of portfolios? Like, if you're thinking about like portfolio construction, we've got a very uncertain environment. Like you said, we're probably gonna have lots of volatility in both directions, depending on how this plays out. Like, how do you think about that overall framework and how investors should think about it?
Yes. So the first thing that we've been telling investors is you have to remember to focus on long-term goals. So even if you're looking at just what's going on in the tariffs here in the first 6 months of this year, let's also remember that administrations are every 4 years. We have to focus long-term and try and avoid some of the noise and acting in emotion when it comes to investment portfolios. So what we like to do is look at the entire asset allocation. And remember, you want to be well diversified. You want to have exposure across international equities, US equities, different areas of fixed income, alternatives. But look at your diversification. Are you well enough diversified that you can withstand these ups and downs in different areas of the market? Can you smooth this out over time? Because that's what we want to do. We want to smooth that out over time. We want to look at those areas where, when there is volatility, are pricing in the worst case scenario. So I'll give you an example. In the first couple months of this year, when you looked at small and mid cap US stocks, I mean, they were pricing in basically the economy was going to collapse. The Fed was never going to cut interest rates, and tariffs were going to be what was put on the White House lawn when they came out with. So that's an area when you look at that. Hey, you know what? If you can withstand short-term volatility and you have long-term investment goals, that's when you invest in those areas. Don't look at your statement every week, but that's when you take advantage of that. When valuations have just given you that appropriate price. And one of the title of our one of the main titles of our themes for this year was paying the appropriate price for the level of risk. We did not see that in U.S. large cap, specifically the Mag 7 and the growth area. But look beyond that. The investment world is not just the Mag 7. There's plenty of more equity markets, not just here, but internationally. And then don't forget, we also have fixed income markets as well.
Yeah, and to your point about looking through this, that's one of the hardest things to do these days because there's just so much information. I mean, I don't know if are you on Twitter at all or no?
I try and limit. I'm going to just say I try and limit social media.
That is a good, yeah. Yeah, it's a good thing. And we probably all would be better investors if we did, because one of the problems is, you're getting these panic one day and euphoria the next day. And it's just very, very hard to think long-term because most investors are not going to make changes to their portfolio because of tariffs and increase their returns. Like that's just the way it is. It's hard for even the best people to do that. So like looking through this stuff is so hard.
Yeah, it is. And it's very, we completely understand it can be painful to look at these daily moves. I mean, let's go back to April 2nd, April 3rd. I mean, those markets were painful for an individual investor to watch. It was painful to see the headlines. But that's where we get very cautious about the fact that emotions can override those long-term investing goals. That's where we really try and focus on educating investors on, hey, if you go back in history, if you enter into a market when it's down 20, 25%, almost 100% of the time, you're up a year later, double digits. So it's trying to educate with as much data and analysis that you can do for investors so that they can look beyond the headlines, we try and tell people, don't focus on the media headlines. It can be very misleading. And as you mentioned, it changes minute by minute, half hour by half hour. I mean, last week we had the markets up and down tremendously because of the spat between Donald Trump and Elon Musk. So, let's get back to the basics. Let's get back to the fundamentals of investing. And I'm not saying that here at Verdence, we don't evolve with all of the changing ways of looking at things in different asset classes and things, but sometimes get back to the basics of why am I investing and what am I investing for the long run?
Just we're going to go to your theme number 3 here, which you alluded to a little bit when you talked about small and mid cap equities. But first, I want to ask you one question about the national debt, because I think that's something a lot of investors are thinking about right now. Because a lot of these administration policies are about cutting spending, or you could argue tariffs are there to raise money and to increase revenue. So this national debt thing and how big of a deal it is something that people debate all the time. And you have people like Ray Dalio, he just wrote a recent book that is about a coming debt crisis. And then you've got people on the other side of it who say, yeah, there is a cost to the debt, but it's probably inflation and higher rates over time. It's not some sort of crisis. Like, I'm just wondering, in your seat, how do you think about the national debt and how to analyze it?
The national debt has been a problem for a very long time. This was after 2007, 2008, when we had to inject a significant amount of money into the economy. The same story happened, that, we're on this projection of deficit that's unsustainable. Absolutely. We're right there on it again, just even worse because of the spending we had to do in COVID. I do believe that the deficit is an issue. I think it's a major issue. I think the biggest risk from an investment standpoint is in the long-term part of the Treasury curve. I think that we will not see zero interest rates, I would say, in my career time. And I don't think that the Fed what this has done is given a lot of limitations to not only the Federal Reserve, but to the federal government from a monetary standpoint. If we end up having some sort of I hate to use the word black swan, no one likes to use it, but if we have any type of unforeseen situation like a COVID, it makes it very difficult for what we can do. I'm not as worried as most that we're going to see, China dumping treasuries, or that all of a sudden everybody's going to flee U.S. investments, because I think that's unrealistic. The dollar is still the reserve currency. I don't see that going anywhere anytime soon. So there's no way that these countries that are our biggest holders of our debt can dump their holdings. It would destroy their economies as well. So I think the deficit, and we've seen the tariffs. I think the last read that I saw, the fiscal or the rolling 12 months, I think we've gotten about $129 billion in tariff related revenue. That's good, but not enough. There needs to be other things to be adjusted in that deficit with the debt projections. And I am not a politician to try and figure out what that can or where it should be. But I think it is an issue. We're on an unsustainable path. We need to, this would be probably one of the worst times in the world to not have a very strong military presence, and we're cutting that. I know in the new bill by the White House that they are trying to increase the defense spending, but we really need to increase spending on certain things that are going to keep us, I guess, as the power leaders for the foreseeable future. And we need to cut wasteful spending. I think that's been addressed in a very contentious way into some people, but we are starting to see that there is a lot of wasteful spending. Eventually, there's going to have to be a political party that will touch entitlements. It has to happen. There's no way that we can continue to squeeze everything else and not touch entitlements. And I think, like I said, I am not a politician. I don't know the best way, but there is a way to do it. The problem from a political standpoint is neither party wants to be the one to do it. But it's going to have to happen. And at some point, whether it's this administration or the next administration, that's the only way that I see we can start to dig ourselves out of this.
So shifting to the market, theme number 3 was global equities expect more muted returns with the bar set high. And, that was very true at the beginning of the year. Then we got a big decline, and maybe those returns were a little bit better, but now we're back up. So maybe they're back down again. So how are you thinking about that right now?
Yeah. So if you're coming into the year, we came into the year with a significant amount of cash on the sidelines. And that was because we had anticipated not the tariff calamity that we saw there. I mean, we didn't anticipate that, but we were doing that because of the fundamentals. The economy was slowing. We did not think the Fed was going to be able to cut interest rates. I think it's coming into the year, people had expected like 6 interest rate cuts. That was not in our cards. We did not think that was going to be able to happen. With the new administration, we've just seen it before. The fact that people were coming into this year dumping more and more money into equities when we know how President Trump, how he governs. We saw it the first time. He is not afraid to come out strong, come out hard, come out with basically a Sotero's worst case scenario so that he can somehow meet in the middle. This was all something that, whether it was tariffs or whether it was dealing with Russia and Ukraine or dealing, with China, we knew that he would come out, the immigration, that there would be volatility specifically because of the new administration. And that completely unraveled just also with the tariff side of things. So we came in with a lot of cash. But when we saw these markets down, the NASDAQ was down in bear market territory at some point. The small and mid caps were down anywhere between 20 and 30% from their recent high. We saw even U.S. large cap value, they were down about 15%. That's when we put some of that money to work, because we knew that this would not be a long-term problem. We did not believe that the Trump administration would let the tariffs overwhelm so much of the first year that he couldn't get the tax cuts and jobs bill extended. The one big beautiful tax bill. He had those two: immigration, tariffs, one big beautiful tax bill. So we knew that that was something he would have to shift his focus to. And also, we knew that those tariffs weren't going to stick. We knew that there would be negotiation and there would be some change. And there may even be some benefit to the U.S. out of these. I mentioned that before, but I just also told you we've got $129 billion more revenue than we did a year ago. So we weren't that concerned that corporate America wouldn't be able to adjust to this. And we weren't concerned that the economy was going to completely collapse. So that's when we added to some of those things. Now you saw one of the also biggest rebounds back. I mean, I think you got to go back to COVID when we saw such a big rebound out of that. And right now, some of the valuations are right back to as expensive as they were coming into the year. So there's nothing wrong with sitting tight. We still have some cash there sitting in portfolios. We're looking for opportunities if volatility arises again to maybe put some more to work. But there's nothing wrong with sitting here and being patient. If there are investors that, the one thing we would really suggest is looking at your asset allocation and making sure you're in line with your tactical allocation or where you want to be for the long run. If things have run up too much and you're overweight in certain areas, take some profits there. Get back in balance. That's important. When it comes to we often talk about equities, and I can address the international side of the market as well. International markets are attractive compared to the U.S., but they have really caught up quite a bit here in the past 6 or 7 months. But look at them over a much longer term basis, still over a longer term basis, underperforming the U.S. at a pretty healthy clip. So there's still maybe some opportunity there in the developed international. We're still a little cautious about the emerging market equities. There's a lot of unknown there because the tariff revenue that some of these frontier or emerging economies, they were relying on that just for simply economic growth. So we need to see some more of these deals and what may happen there and how that can benefit them. But, it's okay to sit tight. We did add also not only to small and mid caps, but we did put a little bit of money into large cap value. Large cap value has underperformed the Mag 7, but what we've seen is in some periods of inflation or when interest rates went higher, that the value outperformed the growth. So we did add a little bit into that as well when we saw them down about 15%.
So at the beginning of the year, you were least optimistic, I think, on large caps, and you were least optimistic on tech. Is that still where you're at?
No, we're not optimistic on technology at all from a valuation standpoint. When we talk about large cap, we kind of split it into growth and value. So when you say growth, that is primarily your technology, your communication services, and these were coming into the year at bubble-like valuations. So no, we were not positive about them. Still think that they're expensive. Given the fact that we don't think the Fed can be as flexible as the market's pricing in. And they are, when you see interest rates rise, especially long-term interest rates, take what happened a couple of weeks ago when long-term interest rates went up, I think 50 basis points in a week. What happened? Tech was hit very hard on that. So We are being very cautiously optimistic because we do think long run it's a great investment to have. I mean, technology, AI investing, all of this is the wave of the future. But what's the price to pay for it? That's where we're stuck. And I think the valuations right now are a bit expensive. They did get cheaper, but in our opinion, not cheap enough to add to that. In our allocation, you always have to have some allocation to that growth side because again, it's a long-term investment, but we'd rather have more of a tilt towards the value at this point.
How do you think about the long-term struggles of value? Because I asked this as a value guy because I've been a value investor throughout this whole thing, which has been painful at times. But people have argued, value investing doesn't work like it used to, or because we have these big tech firms, the market's investing in value is just not a smart idea. These companies are just dominating the market. Like, do you have any thoughts on that in general?
Yeah, I think a combination of the two is the way you have to do it. It doesn't have to be one or the other. And I think people forget about that. I think people think, oh, well, I have to be a value investor, or I have to be a growth investor, or I have to just invest in the S&P 500 index, the SPY as an ETF. No, absolutely not. Let me take any one of those investors back to 2022 and take a look at what happened. This is over the long run. It is proven to have exposure into both of those areas. But where do you want to weight it? If you're looking at the next 18 to 24 months, what's the valuations that are being priced in for that outlook, and how do you want to weight that? So we're still leaning towards having that combination because it will smooth itself out over time. There'll be times when value will outperform growth. And in the past 3 years, I mean, I've been doing this for 27 years, and I will say that for probably 80% of that, everyone wondered if value is dead and, should they ever invest in anything else but an S&P index? Well, in the past 3 years, we've seen multiple different occasions where value has held up much better than growth, had a little bit less volatility. So when you're looking for the long run, you need to have some combination. If, for example, the interest rate of the Fed needs to be cutting interest rates aggressively, that's where you might want to look, and you see a pullback in both areas of the market. You might want to look at adding a little bit more growth. We're just not there right now. Inflation is still an issue. Valuations are still too high. And I still do think that earnings may be a bit high and need to come down further.
So when we roll up valuation to the overall market, how do you think investors should think about that? Because, you see a lot of charts on the internet or on CNBC about the market is expensive, but then other people will argue on the other side that the market's been expensive relative to history effectively forever now, and we're in a different type of market that's dominated by tech, so it deserves to be more expensive. Like, how do you think your average investor should look at the market valuation when they see it? Is there anything they can do with that?
I tell them to take a look at those articles, and then let's go back to 2006 and 2005 when you saw housing prices at a record high and say they couldn't go nowhere but up. And let's remember that's not necessarily always the case. So I do think that there is room, and I do think that technology is a big driving force of our economy going forward. We do have the leg up on technology from a global perspective, but it doesn't mean that I'm going to pay the most expensive price for it. I'll just wait until it gets a bit cheaper. I do think the concentration in the S&P 500 is a risk to those that think I should just be invested in the S&P 500. It's a concentration risk is a major thing. I would never invest to a client to invest in a manager, a mutual fund, a separately managed account that their entire concentration or was in 2 stocks or 5 stocks or 7 stocks. I would never do that. Another kind of way to think about it is, would you ever invest in an investment where their number one holder holds 70% of the investment? No. Its concentration comes in many ways, forms, shapes, and sizes, and concentration in anything is a concern. You have to diversify some of that away, because when there is concentration in those, guess what else there is? High correlation. And when you have high correlation, when those concentrated stocks fall, they're going to fall, and they're going to fall hard. They're going to fall together, and you've got nothing else to diversify there.
You mentioned international before, and I wanted to ask a little bit more about that, because on one hand, you've got a very good valuation argument with international stocks. They've been cheap. Now, some will argue they've been cheap for a long time, but they are cheap right now. And on the other side is sort of the macro argument right now, which is if U.S. exceptionalism or the fact that the U.S. is just going to outperform everybody is taking a step back now, you could argue that could be a macro tailwind to international stocks. Like, how do you think about that?
Yeah, I mean, absolutely. I think that the U.S. obviously coming out of COVID, we did weather the reopening and getting the economy back on track better than I think a lot of other countries. That's not to put any country down. We were all in an unknown situation, but I think that the international side now. There's two different things why I tell people to look at the international. Valuations is one of them. We mentioned them. Over a long-term valuations, they're still cheap compared to the US. But here's a little bit of a difference. The European Central Bank has one mandate. We have two. So the European Central Bank has been able to cut interest rates. And I know that they just recently came out and said that this may be it, or they may be on hold for a while. But they have been able to be very flexible with monetary policy. Because of our dual mandate, we don't have as much flexibility. So I think you want to look at areas of the global economy and global equities that have that flexibility to work with interest rate policy. When it comes to debt, I mean, we're all in a bad debt. Debt is a global problem. So Europe's got it. Everybody's got a debt problem. So, putting that out of the equation, I do think that what Europe needs to do is find a sustainable path to get their economy really jolted back to life. But at the same time, while they've been cutting interest rates, trying to get their economy to really get on a sustainable path forward, our economy is slowing and our Fed really can't do much about it. So that's why I think that, making sure you have some of that exposure in the developed international is a good thing to have in your portfolios right now.
Do you worry at all about the idea of capital flight from the U.S.? I mean, we saw some short periods of time where, you had bonds, stocks, and the dollar all selling off simultaneously, which is sort of a sign of that. Do you worry that like a lot of these funds abroad are going to start to lower, not some sort of dramatic thing, but like they're going to start to slowly lower their U.S. allocation over time? Maybe that's bad for the U.S.?
I don't think I'm not that concerned that it's going to make a dramatic difference. I still think that, as we've mentioned, the U.S. dollar is the reserve currency. So having U.S. assets is extremely important. I'm not concerned that there's going to be this massive flight. Do I think that there might be some shifting of allocation? Yeah, and there always is. This happens all the time. These are cycles. That's what we call a cycle. You shift to the better, and then and this may go on for years and years. But when it comes down to where focus is, technology is U.S. As long as the U.S. can be in front of the AI evolution as well, I don't foresee the U.S. losing that need for it to be in portfolios. I don't foresee that. Can we withstand some capital fleeing out into other areas? Sure, that's fine. Guess what else that does? It makes valuations more attractive. So I'm okay with that. Because again, long run, not the next 12 months, long run. And right now we have seen so much capital float into here that we have seen valuations just so unrealistically and unsustainably high that I think it's not the end of, I don't view it as the end of the world if we start to see people have some more diversification. In fact, I just think that might even help over the long run volatility in the global equity markets, because not everybody, again, we get back to that word concentration. Not all global accounts are concentrated in just the Mag 7. Now we've got diversification.
And to your point, it's always good to look at those large pools of capital. I think it's like barges. They're not going to have a meeting and be like, sell all the U.S. equity tomorrow. If they're going to make shifts, it's going to be really, really slow, and it's going to take a long time to happen.
Yeah, absolutely. I mean, it's kind of like, as I mentioned earlier in the call about the treasuries, you're not going to have countries that hold a significant amount of our treasuries just dump them all at once, because that's just going to destroy their economy. It's going to destroy returns. So these may be things that gradually happen over time, but they're also not necessarily unhealthy. What is unhealthy is having your entire portfolio in the Mag 7.
So your fourth theme was fixed income higher for longer. And you alluded to the Fed earlier, and I wanted to pick up on that a little bit more. What are you thinking about the Fed? You talked about earlier, you're thinking towards the back end of the year, they may have some cuts here, but you also seem to be very worried about inflation. Like, do you think they should be cutting, or do you think they should just kind of be staying the course right now? What are your thoughts on what they should be doing?
Well, first of all, tremendous respect for the Federal Reserve because they've been in a very difficult position for the past 5 years. I would not want to be in their situation. What if I had my way? What I would prefer the Fed do is I think they have the flexibility to cut interest rates. I think it will probably be a September story. I don't think it's going to be 50 basis points. I think they'll go back to the 25 basis point increments. The economy, if you look at every other indicator aside from the labor market and inflation, if you look at manufacturing, if you look at housing, if you look at the consumer, if you look at leading indicators, all of these things are pointing to us that we should be in recession already. But we haven't officially hit that technical definition of recession. I do think because of those many factors and some of the cracks starting to emerge in the labor market. I know there was a lot of optimism around the report that came out last week on the labor market, but let's be honest, we still are seeing some cracks emerging. We've finally gotten what the Fed wanted to see. The Fed wanted to see that job postings came down faster than the rise in unemployed. And we just finally are seeing that. We're seeing that equilibrium come back into place. That's not only good for the labor market, but it's also good for inflation. So I think that the Fed has that flexibility to take a precautionary rate cut. Like I said, 25 basis points is probably the smart thing to do. I don't think it's going to dramatically impact inflation. What I think was the kind of a difficult thing that they did last year was, cutting by 50 basis points and basically setting up for ongoing interest rate cuts at the time when we didn't see the full labor market picture until many months later. So that's why I think the Fed is what they should do, cut interest rates by 24 basis, deliver it with a hawkish tone. A hawkish tone meaning that, hey, we're doing it this time because there's signs of weakness in the labor market. Inflation is getting close to our target, but don't think that we're going to be cutting at every meeting that we have now. It is a wait and see approach from here on out. We will take all of the data into consideration. I think that will help to reduce a euphoria around, hey, we're cutting interest rates, because too much in a recency type of mentality with investors is that over the past, what would we say, 15, 20 years maybe, the Feds, every time that there's signs of weakness, they just come in and we're right back to zero again. Can't happen. It's not going to happen. They need to articulate that they will be very methodical. They will take into consideration inflation, the inflation outlook, as well as employment.
Just one more from you before I hand it back to Justin. You mentioned indicators, and that's always been interesting to me because we've seen in this cycle a lot of indicators that traditionally have worked maybe haven't. So if you think about the yield curve inversion, the SOM rule, like a lot of these things that typically indicate recession triggered, and again, they could just be a lag here, so they could work, but they haven't worked as well. I mean, do you think that goes back to the stimulus you were referencing in the beginning? Maybe we've got some one-off stuff going on here that hasn't occurred in the past occurrences when those have happened?
Absolutely. I think that we've distorted any historical analysis that many of us that look at economic data, on a regular basis. What the stimulus that happened during the pandemic and after the pandemic has distorted all of those. I still believe in them because guess what? Everything mean reverts. And I do think that we'll get back to being able to really look at the economic fundamentals once we've cleared out the stimulus and once we get spending under control. We do need to get any fiscal spending under control. I do think that it's been a big source of why the consumer's been so supportive. I think, again, I don't want to pick apart everything that we did after that. At the end of the day, we had no idea what we were in for. We had no idea what to expect. We were just trying to keep the banking system, the economy from completely going into some sort of a depression. So I think some of the things that were done were necessary, but it didn't stop there. We continued to extend some of these benefits, even when we saw things like job postings that were at historic highs. We continued to allow people to, wait to get a job because they had that stimulus. And unfortunately, that I think has led to a lot of different issues with being able to look at some of the things, as you mentioned, as our traditional tell-all tales of recession.
You in that fourth theme with rates, you talked about the increased yield volatility. and sort of why treasuries might be challenged here. So can you just talk to that a little bit? And then I think also in the piece, you sort of highlighted, where there is opportunities in credit and some places you might avoid.
So when it comes to the fixed income market, my biggest concern is long-term interest rates. And that is primarily because of the deficit. And then what does the deficit mean for long-term inflation? So we are no longer in this low interest rate, low inflation environment. That's I think a thing of the past. Right now, I think the long end of the curve is reacting to the uncertainty about the bill that just went through, about our discipline around fiscal spending. And then obviously, we did have our rate cut as far as our AA. We lost our AAA rating. So there is some of those just underlying factors that drive interest rates. But the long end of the curve is my biggest concern. We don't think that you should avoid fixed income. If fixed income has proven over time, maybe not specific years or specific points in time, as a portfolio diversifier. So you shouldn't avoid it, but you can be defensive with it. So stay in short to intermediate portions of the curve. Municipals. Why would if you're in a higher tax bracket, municipals have extraordinarily low default rate. I think that they've had a very challenging year because there's uncertainty around if we would have what the SALT deduction would be. Would municipals lose their tax exempt status? In my opinion, that's not happening. If municipals were to lose their tax exempt status, that only puts further burden on the federal government. And municipals have attractive treasury to municipal to treasury ratios. So municipals it's always an option to look at, but I think even more this year because they've had a challenging year. And remember, you're buying municipals to clip the coupon for tax exempt income. You're not necessarily buying them for the long-term growth. And if you're getting that tax exempt income with very, very low historical default rates, that seems like a no-brainer to me. We have actually also gradually increased our municipal exposure over the past year. When it comes to credit, and this is where the opinions differ quite substantially. There's investment grade credit, there's high yield credit. When you look at the extra yield that you're earning to own either one of those, historically tight. And some would argue, well, so what? The absolute yield is high. So why wouldn't I buy, a high yield at a 7 or 8%? Well, you wouldn't buy it because you're not getting much over the treasury. And we just talked about how the economy is slowing. And when the economy slows, you typically tend to see defaults and bankruptcies pick up. So we're waiting for valuations into simply credit side of the market to improve. Private credit is an option if you can invest in private investments. I think private credit does offer some good opportunities for people that can invest in them and also have a long-term time horizon. And the only other thing that we're looking at is there a time we have some exposure to some shorter duration fixed income paper, but there's other areas of fixed income that we'd love to look at, but they're just too expensive. Preferreds is one of them. That's an area everybody forgets about. Good old boring preferreds, but guess what? They tend to pay a nice good coupon, and right now I think they're expensive, but if you can get them cheap, then they're a good opportunity as well. So we have a lot of things within fixed income on what we call our shopping list, but right now it just continues to be expensive.
So the last theme in the paper was alternatives, a shelter from expensive public market, a shelter from expensive public market. Mm-hmm. So how do you think investors should think about alternative investments? I mean, there's a lot of new options and products coming on the market that are giving retail investors exposure to these private markets. So just in general, how do you think of alternatives, where they fit in a portfolio, what the risks and opportunities might be with alternatives?
I think alternatives are a fantastic way to add non-correlated assets into your portfolio. They're non-correlated. In the illiquid side of the private markets, you don't have to deal with the daily volatility. You tend to get a return over the long run that rewards you for that lack of liquidity and for the risk that you take. The risk that I see in the alternative space in general is a couple of things. Keep in mind there are liquid alternatives out there that any investor can invest in. We own some liquid alternatives that have actually done very well in this volatility that we've seen this year. They've done well in 2022. They've done well, period. And these are things you could trade every day. But there are a lot of investments that are trying to get into the retail world that maybe have lockups. Keep in mind with that. There may be some interval funds that make me concerned because they can quickly, in times of distress, limit the amount that you can withdraw from them. So the one thing, if you're going to invest in, whether it's the illiquid side of the market or the liquid side of the market when it comes to alternatives, is due diligence. It is extraordinarily important to know what you're buying. And we have at Verdence here, we have a dedicated team that focuses specifically on alternative investments in both the public and private space. And they spend an extensive amount of time going through every single document, which is not a ton of fun, to make sure that we're getting the appropriate investment. But you also want to make sure you're not overweighted to maybe when it comes to the illiquid space. You want to make sure you have diversification there as well. Diversification in a public market portfolio where you have stocks, bonds, maybe commodities, it's just as important in an alternative portfolio. You want to make sure you have you spread that across to private equity, maybe some venture capital, mezzanine debt, private credit. You can have real assets, infrastructure. Make sure you're getting enough that you have a well-diversified portfolio as well. And that's important. I think sometimes when it comes to the illiquid side of the alternative investment world, people get really intrigued about a new hot deal, but they don't look at what their overall allocation to alternatives looks like. So make sure that you're diversified there. And it takes years to build a good illiquid alternative investment portfolio. Be patient, wait for the right investments, and make sure you know what you're buying.
Can you just give us some examples of like what you would consider like real assets to be in alternatives?
One areas that we like is infrastructure. And this is because, again, infrastructure seems boring. We always need infrastructure, blah, blah. But infrastructure goes beyond just, roads. This is infrastructure into actually owning specific things. This is in the illiquid market. But you're also locked in with leases, and and these things tend to give you really good steady income as well. So you can get some price appreciation, but it almost can be like an income alternative to, let's say, fixed income or equities. But infrastructure is a great real asset. Real estate is another one, but not yet. Especially commercial real estate, there's going to be some phenomenal opportunities from a commercial real estate side. That's another one you want to make sure that you have very good due diligence on. But there's real estate is another option there. Those are the two that we look at closely from a real asset standpoint.
So you've answered all these questions. So great. So now here comes the next two questions, which are our closing questions. These are the hard ones, Megan. So get ready.
Okay. All right.
So the first one is, what is the one thing you believe about investing that the majority of your peers would disagree with you on?
I think that most investors would disagree that active management is still very important. I think most people think that passive investing is the only way to do things. And I think that, again, is a recency bias. They've seen that the S&P 500 has really been the only thing that's done well leading up to really 2022. And when I talk about active investing, I don't just mean a pure active asset allocation, and that's important. So you can't just dump all your money into like an S&P 500 index and maybe a 60-40 kind of portfolio. You really want to make sure in your active investment that you're looking at mutual funds, managers. When I say managers, I mean separately managed accounts, that they're doing some of that hard work for you, and you can focus on the asset allocation while they pick the individual stocks. They're going to know which stocks may be the most susceptible to some of the political risks. But asset allocation, that's if you can master the asset allocation, diversification in the long run, make sure that you're looking at active managers, not simply just using an index in place of these. These active managers Most of them, not all of them, have proven over time that they more than make up whatever fee it is that they charge for clients. So I think that that's very important. And I think most people would disagree and say that passive investing is the wave of it's here to stay. It's going to be here forever. I don't agree with that.
And lastly, based on your experience in the markets, if you could teach one lesson to your average investor, what would that be?
Don't follow the FOMO. Do not look at FOMO. That is something that we've seen momentum-driven trades drive these markets up, and as much as they drive them up, they deteriorate at the same time. The second thing is don't let emotion override long-term discipline.
Great. Thank you very much, Megan. Really enjoyed the conversation.
Thank you. It was great talking to you guys. I hope to do this again soon.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.